Gold is down almost 40% from its 2011 high. So can the precious metal recover its shine? To answer that, we're joined by Axel Merk. He's the President and Chief Investment Officer of Merk Investments. Axel, thanks for joining us tonight.
Great to be with you.
So Axel, gold is down about 39% from the high of $1,899 that it reached in September of 2011. It's down almost 10% over the past year, down 5.6% over just this past month. Axel, why has gold lost so much of its value?
Well, a couple of years ago when it reached its highs, remember it was up for 12 years in a row and some folks used leverage. And so as some people had to de-lever, that piled on, people piled onto that, and then people then sold out. What's been happening in recent months, though, is a little bit different, I think, that there is this perception, and your previous commentary showed it as well, that everything is great in the U.S. We're going to have this wonderful exit at the Federal Reserve, and interest rates are going to go up. In fact, most world stock markets aren't doing so well, so global investors are buying the U.S. stock market. With that, the dollar has been rising, and gold has been coming down. To me, that raises a couple of concerns. Most notably that maybe the global investors are the so-called retail buyers that are jumping on the bandwagon here very late. But as far as gold is concerned, I think what's going to happen is that people are going to realize that even if we have a rising of interest rates at a very hawkish level, so to speak, we might have the federal funds rates, short-term interest rates, at 1.75% at the end of next year. If so, real interest rates, meaning if you deduct inflation, the current inflation from the rates, you will still have negative real rates. That's a positive for gold because gold doesn't pay any interest. So if after inflation you have more by holding a brick than you're holding cash, that's good for gold. And if you look out many years from now, in 10 years from now, I don't think we can afford positive real interest rates and deliver on all the promises that we've made to the elderly and so forth.
Well, Axel,
we have the problem, yeah.
Axel, I hear you about the Fed printing money, QE 1, 2, and 3. That came and went. We didn't see the inflation that was concerned, or the inflation that materialized didn't drive gold higher. But now QE is over. Is there a reason for gold to rally? Gold is a hedge against inflation, but grain prices are down, iron ore prices are down, crude oil prices are down, rubber prices are down. So what is supporting your view that gold will rally?
Well, two things. First of all, I think commodity prices, including gold, are down because we have a slowdown in the global economy. Everybody thinks the U.S. is going to bail everybody out. I don't think so. The higher dollar is going to hurt corporate America quite a bit. There's going to be a very rude awakening there in the stock market. It's going to have ripple effects throughout the world. So I don't buy that story that kind of we have a good exit. And by the way, QE is over. That's easily said. But we don't. QE is we're not printing additional money, but we have created a lot of money. The monetary base has gone up. Former Federal Reserve Chairman Alan Greenspan recently said the Federal Reserve is sitting on a box of tinder. I would very much agree with that. We have been lucky that these policies have not worked. Let us have economic growth. Well, what then? How are we going to rein this all in?
Axel,
and central banks say, trust us, but these problems are there. They are there in the future. And at some point, the gold price is going to reflect the issues in the future.
All right, let's focus on what's happening in central banks around the world. Russia has been increasing its gold holdings, trying to stabilize the ruble. Russia's central bank is now been buying the most active official sector gold buyer over the last decade. How is this impacting things?
Well, generally speaking, obviously, Western central banks have not been buying. Eastern central banks, including Russia, have been buying. The wealth is moving towards the east. That's a trend that's going to continue. In the long run, you cannot support a welfare state and retain the purchasing power of your currency. And we've had way too many obligations made in the U.S., in Europe, in Japan. And so with that, it's only natural that gold is migrating towards those countries. And yes, the most concrete evidence is of late that Russia has been increasing its gold buying. Now, other central banks have stepped aside and not doing anything right now. They're very glad that our currencies are currently weakening.
Axel, a return to the gold standard in any form is nowhere on anybody's horizon. So does it even matter that central banks are stockpiling on gold or not stockpiling on gold?
Well, I would agree with you. Over the last 100 years, we've moved further away from the gold standard. And if anything, it matters to individuals because if they like a gold standard, they have to have their own individual gold standard. Now, Switzerland has this vote coming up on November 30th to force the Swiss National Bank to increase its gold holdings. That's great as a discussion point, but it's not going to tip the tide throughout the world. Ultimately, though, if you're an investor, if you're in Japan, for example, and you're seeing what the Abenomics is doing to the purchasing power of your money, you got to say you got to do something. Now, culturally, the Japanese might be more interested in buying diamonds, but in other places of the world, they will be buying gold. We cannot retain the purchasing power of the dollar and deliver all the promises we've made without massive tax hikes that are not going to come. And so the path of least resistance is to debase the purchasing power. We are better in the U.S. at, quote-unquote, kicking the can down the road. And so if you look for the next decade or so, I'd much rather hold gold than hold stocks that have gone up year after year and year, have gone up 20% a year.
All right, we're going to have to leave it there. Axel Merk, thank you so much. President